Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josey. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josey. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josey, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is creative ways to fund your first investment property. Getting your hands on your first investment property can feel impossible, especially if your bank account is giving you the side eye. But here's the secret. There are plenty of creative ways to get the deal done, even if you're not rolling in cash. It's about using your resourcefulness, building relationships, and thinking outside the traditional lender box. Here are 5 actionable tips to help fund your first investment property. Number 1, team up with a partner. You don't have to go at it alone. Find someone who has the funds but not the time or expertise and offer to do the work in exchange for a share of the profits. Partnerships can be a game changer when you're starting out. Just be sure to choose wisely and get everything in writing. Number 2, seek out private money lenders. Look beyond the banks. Friends, family, or local business owners might be looking for better returns on their money. Present a solid deal, show them the numbers, and offer them a fair interest rate. Number 3, try house hacking. Buy a multi-unit property, live in one unit, and rent out the others. Not only can this help you cover your mortgage, but you'll also gain firsthand landlord experience. Plus, lenders often love this setup for first-timers. Number 4, negotiate seller financing. Some sellers are open to acting as the bank, meaning you pay them in installments instead of getting a traditional loan. This can lower your upfront costs and make deals possible that banks might reject. And number 5, leverage your existing assets. Tap into the equity of your home, use a retirement account, or even sell unused assets to raise capital. Just be sure you understand the risks and have a plan to pay yourself back. So, RAIN Nation, remember, the path to your first investment property isn't always paved with your own cash. It's about being bold, building relationships, and getting creative. Use these strategies to kickstart your journey and show the world your badassery. Now, on to today's episode of the Real Estate Investor Growth Network podcast. My guest is Mike Zlotnik, known as Big Mike, CEO of TF Management Group and a full-time real estate investor since 2009. With a mathematician's mind and a tech background, Mike takes a numbers-first approach to analyzing real estate opportunities. He's a board director at Collective Genius, a member of masterminds like Freedom Founders and CA Investors, and host of the Big Mike Fund podcast, ranked in the top 10 globally. Mike is also the author of How to Choose a Smart Real Estate Investment Fund and manages a diverse portfolio of real estate funds. It's my pleasure to have him on the show, so welcome Mike Zlotnik.
Thank you, Jen.
Or Big Mike. You're just Big Mike to everyone, aren't you? Thank you so much for being here today.
Thank you for having me.
And where are you located? I didn't even ask you before we hit play.
I live in Brooklyn, New York with my lovely wife with 4 monkeys and a cat, 4 human monkeys. So I've been here for a long time, and so it's good old Brooklyn.
Wow. I don't think I've ever interviewed anyone living in the city. So wild. All right. Anyway, I digress. Before we go into today's discussion, talking about numbers and things, I do know a few badasses in collective genius. Can you tell the audience what this powerhouse group is about?
Yeah, I'm a super veteran of the CG. It's kind of funny that the founder of CG, when he asked me on stage, here comes Big Mike. He's been in the group only for 7 years. I said, Jason, his name is Jason Medley, he's the founder. I said, Jason, you either got a memory problem or a math problem. And as a mathematician, you definitely don't have, you don't know the math. I've been in the group since 2012, and he would say that in like 2025. But it's a brilliant group. It's a great group. They have a lot of residential guys and girls who do fix and flip, wholesaling, wholetailing, burr strategy, anything that has to do with residential. These guys do. The group is phenomenal. A lot of expertise in marketing, biz dev, automation. How do you talk to a seller? You just talked about creative strategy. Some of the folks just approach a seller, give them three offers. Here's your cash offer. Here's your pivot offer with mix of cash and seller finance, and this is purely bank financing. And then you could steer them into no cash down, seller finance, everything, because the other two offers don't look as interesting. So the group has a lot of smart cats, and they all
Yeah, they do.
do heavy resi. Although there are some commercial guys like me, I'm not bird. I do more of commercial, but we started years ago financing a lot of fix and flip deals, hard money loans. So yeah, the group is full of these badasses, residential guys and girls.
Yes. And so it's a mastermind, though, correct?
It is a mastermind. Yes.
And how often do you meet in person?
4 times a year, a couple of times typically so one time in Tampa, one time sort of San Diego area, and then now we've had last couple of meetings in Dallas, half the way.
Okay. Well, I see some photos on Facebook of people attending those events. I'm like, damn, there are some pretty impressive people in that room. So thank you for sharing that. And we are going to we're going to kick off this whole conversation here about things I do not normally enjoy discussing, which is based on math. And so I'm actually grateful to have you because I'm married to an accountant. And so this stuff is just like no brainers for him. But for me, I'm like, I kind of glaze over sometimes. So I am excited to ask you these questions. But to kick things off, how are high interest rates reshaping real estate deal structure in 2025? And what changes are you seeing firsthand? That's a
Sure.
loaded question.
It's a great question.
Okay.
Yeah, the higher for longer interest rates have been certainly an issue for commercial real estate and also for residential real estate. We've
Right.
seen some markets have corrected in residential, some are still holding up. In commercial, a lot of things corrected because commercial real estate, and when I say commercial, I mean multifamily, small apartment complexes, could be anywhere from small number of doors to 1,000 doors.
Wow.
Could
Okay.
be storage, could be industrial, could be open air shopping. All these deals that financed with floating rate debt or variable rate mortgages, a lot of them have been liquidity squeezed, cash poor. Some of them have equity, some of them don't have equity. So the deal structure very much depends on the situation on the deal. So on the existing deals, they need rescue and recovery capital. So higher for longer interest rates have caused these deals to suffocate the same way the new capital is coming in, and it's coming in kind of as less money in, first money out. What it means is
Interesting.
after the mortgage, of course, after the bank loan. If a deal is still a good deal and it needs some fresh capital, it comes in as rescue and recovery capital. These are not math terms, but the short version of it, all the past investors, all their money that were in the deal get pushed back, the new money comes in, and who has the gold makes the rules. And the new money makes the rules of how the deal is going to go on a forward basis. The old investors just ride along. If the deal survives, they'll have a chance to make their money back. If not, they lose money. So that has an impact. Just one example. Another example, the new deals, the most beautiful part today, a lot of these projects are distressed. Not the property, but the financial structure.
Oh,
The
okay.
property may be doing well, but the owners are running out of money and they can't pay the bank. So you have a situation where ownership is distressed, the bank is not happy, it creates opportunity. One person's problem is another person's opportunity. So if you find a deal like this, motivated seller, distressed bank, you can come in, make a great offer, and buy a property from a motivated situation. Is it true for residential and commercial? Yes. The concept applies to both. We deal primarily in commercial deals, but plenty of these type of situations apply to residential properties. You find,
Right.
the basic rules of deal finding. So how these deals get structured? Well, the new capital and the capital structure of these deals will depend on what kind of deal you could get. Some situation you could do subject to creative finance and commercial, very,
Hmm.
very common. If the deal has great fixed rate debt for years to come, perhaps the owner will be happy to just walk away and you take over the mortgage through a trust structure or other structure, bring in fresh capital and finish the project. So the deal structure today depends on what situation you walk in, but they're driven by some level of financial distress. Your ideal target is a good, happy property, but distressed owner because they can't pay the mortgage or some other circumstances.
And you explained that so well. And so, first of all, Big Mike, thank you for that. But I understand the variable loans that a lot of people do in the beginning, as opposed to going to like a 30-year fixed type situation that the community is used to. But what would cause the owner to become distressed? That's the part I didn't understand.
So very, very simple. A lot of deals in commercial real estate, not stabilized deals. So stabilized means you have a
Okay.
multifamily property with 95% occupancy or 92%. If it's a industrial or open air shopping, similar idea, where you have the tenants that pay the rent at the level over 90%, 92, 95 in that range, right? That considers the property to be stabilized. Imagine you have a value add. So value add, there's all kinds of value add projects. One is you have to renovate a bunch of apartments and increase rents. Or you're redeveloping. You're taking an old Sears and you're developing into a self-storage. Or you're building ground up, right? So you're basically doing significant value add in the form of construction, development, redevelopment, or other value add. You can't finance it with a fixed rate debt. In commercial real estate, these mortgages are not available. And by the way, in commercial real estate, you don't see 30-year fixed. You see 5, maybe 10 years fixed. You could still be on a 25-year amortization, but
Okay.
you basically have fixed period is way shorter. So plenty of people, when they took on these value add projects, they couldn't get any other financing other than what is known as bridge. These
Yes.
bridge loans, they are like 3 years plus 1 and 1. But the 3 years, the interest rate is tied to the what is a known secure overnight funding rate. They use the term SOFR. So imagine it's the same level, it's the same, almost identical rate as the Fed funds rate. So the Federal Reserve controls the Fed funds rate. And when it started, the Fed funds rate was a quarter. When they jacked up the rates fast and furious, it went to 5.5 over a very short amount of time. Remember that period from 22 to 23? And when that happens, all these variable rate loans, the rate on the loan, let's just say it was 3% plus the Fed funds rate. Say it was initial rate 3.25. When the Fed pushed it up by 5.25%, then the new rate on the mortgage was not 3.25, but 8.5,
Oof.
right? That's what caused the problems. So your mortgage payment doubles or even more than doubles, and that's the problem. That's what creates distress. The property may be fine, but when they borrowed the money on a variable rate mortgage, the plan, renovate the units, increase rents. The problem is nobody prepared for the rates to go up this much this fast.
And do you also think that reasons for them not being able to stabilize a property is just because people can't afford to live there? Like, what's that side of it? Why they're not being stabilized?
Yeah, that's a great, great, great question. So we've seen a few things. One is the pressure from the financial side where the interest rate spiked, right, creating
Right.
the condition I just explained. The second one is when people looked at a lot of these deals, they made assumption, yeah, I'll renovate the property and I can charge $1,500 a unit, where before renovation it was $1,100 a unit. As an example. And they ran the comps and they did all the math and all the estimation. When the reality hits, it's a way harder to do. The renovations took longer. There were problems, delays, couldn't hire people during the COVID, et cetera, et cetera. So you wound up renovations taking longer, renovation costing more money. Oh, and you try to rent for $1,400 or $1,500. Somehow, a bunch of other people built properties nearby, and the market just got oversupplied. So the
Yep.
average going rate is no longer what you thought it was going to be, but it's less because there's more competition. Same thing happened in self-storage. A bunch of other people build self-storage facilities. So you thought you could charge $100 a month for that storage box. Now it's storage wars. They're fighting for that occupancy, and the first month is half price, and the next 3 months are half price as well. So these operating challenges hurt a lot of projects through more difficult execution. Oh, and tenants don't want to pay. Oh, it was a really Class C property. You get some crime in the area. And then, oh, insurance companies went insane with the insurance premiums when the hurricanes start hitting. Oh, the tax man needs more money, and the municipality is adding more. So you all these variables just kind of like perfect storm. Everything hit from many directions, and number of projects just couldn't withstand it. And if it all happened on 1 out of 10, be one thing, but it was like a tsunami wave. It hit everybody all at the same time, and it's a huge tsunami wave. So that's why you hear these stories that strategies, not a single deal, are under massive pressure because it all happened all at the same time.
That was a lot to
But
unload.
it's a land of opportunity now because a lot of these properties can be bought at a steep discount. We've actually seen this. So
Yep.
there's a very important expression that they use. You know what's the difference between an optimist and a pessimist? An optimist, well, pessimist sees a difficulty in every opportunity, and an optimist sees opportunity in every difficulty. This is an opportunity. There's a difficulty, but it's also an opportunity if you're on a buyer side.
Very well said. And we're recording this in, what are we in, September, and it's getting released later, but we just had a 0.25 percentage point drop. How is that going to affect everything that's going on in the commercial side of real estate right now? I'm just curious.
Sure. So I'll give you the crystal ball. And there's I think it's an ancient Chinese expression. If you live by the crystal ball, you will eat grass off the floor. So anyway, all these are speculative conversations. I'm happy
Okay.
to guess and speculate. My theory, and this is under the First Amendment free speech, I could be completely wrong, and it's very possible that every single listener will know way more than I do. I'm like, I could be a smart guy. I can also be a complete idiot. So I don't know any of this stuff. You have some level of I am a scholar of the Fed. I do follow, although they've proven, they've caused a lot of grief for me and a lot of people with their interest rate hikes. I'll tell you this. The Fed is actually a drug dealer. I don't know how else to put it. They are a freaking drug dealer. They have given a drug called ZERP. You have cocaine, you have crack, and there's a ZERP. It's the math. It's whatever you want to call it. They've given ZERP, zero interest rate policy, for a long, long, long time. And they got all of us addicted and accustomed to this drug. And suddenly they withdrew the drug very fast when they hiked the rates. They just said, listen, after 20 years of you enjoying this drug, we're done. So that caused a lot of grief, a lot of pain. So that's the first element. The second element is today they cut, well, not today, but very, very recently, they cut interest rates quarter September 2025. They did this a year ago. They cut interest rates by 1% and they stopped. Inflation, who knows what's going to happen. So at this point, they're projecting 3 cuts for 2025, including the one that they just implemented. And then they're going to continue to look where they are. They claim to be data driven, but they look in the rear view mirror, and sometimes they look in the windshield and they change their song. So I'll just tell you, as much as they try to be stable and consistent, there's a lot of inconsistency in what they do. And unfortunately, they control a massive economy. Now it's actually very funny. About a year ago, I had a video and I had a whole series educational called "Who is More Powerful, the Chair of the Federal Reserve or the President of the United States?" And now we have that conflict happening right now. You have President Trump battling Jay Powell, the Chair Powell, and Powell is still says I still got the power, but directionally the President Trump will replace Jay Powell as soon as his term is over. We're going to get more cuts. So the forward outlook between now and the end of 2026, at minimum, we're going to see about a 1.5% reduction, more likely 2% reduction through these many quarterly cuts, right? Just by the end of the year, we have 3 cuts. Even if they do 2 and 2 more by May, they still have plenty of room by the end of next year to get to a full 2% reduction. So what we're going to see is that interest rates coming down on the Fed funds rate. And the Fed funds rate controls what is known. Now I'm going to use fancy terms. Now we're going to use the Wall Street terms. I hope the audience doesn't get upset at me. It's called the short end of the yield curve. So what the hell is a yield curve? Yield curve just means bond rates, from long duration bonds to the short duration bonds. The Fed controls the kind of overnight or very, very short maturity bonds. So the yields on these bonds will come down, and every time they cut a quarter, what bank pays on the demand deposits, on the checking account or money markets or savings will come down as well. So these rates will come down, they said, about 1.5%, 2%, probably, maybe even more, depending on how the economy does, what happens with inflation, employment, etc. And then there's also what really matters for real estate, what controls all the mortgage rates. It's the 10-year Treasury yield. The 10-year Treasury yield is what drives majority of the mortgage rates. And that has started to come down a little bit recently. We were at 4.5, we're down to, let's call it 4.1. And my crystal ball prediction, we're going to be at least 50, maybe 75 basis points or half to 0.75% lower. So the lower end of the yield curve, what the Fed controls, will probably drop 1.5 to 2%, while the 10-year rate, which controls the mortgage rates, will probably drop 0.5%, maybe 75 or 0.75%. If it drops more, I will be the first to be extremely happy and welcome that news. But I think at least we'll get 50 to 75 basis points reduction, and that'll help real estate. That's tailwind after the years of headwind. I'm gonna stop. I hope I kind of explained that whole environment, how the bond yields trigger mortgage rates,
Yes.
not the Fed action. But the way they're tied, most people don't understand how they're tied, is through an economic concept called substitution effect. Imagine you own a bunch of very short maturity bonds. You don't want to lock your money for long term, and you're getting wonderful yields. As Fed continues to cut, you're going to get less and less and less. And then your bond's going to mature, and you're going to roll the money into lower and lower yield. So you're sitting there and you're thinking, this is not interesting. I need some better returns. And it'll either trigger you to do something else, maybe put the money in real estate, or maybe if you are a fixed income investor, you'll actually go for a longer maturity bonds, meaning you will buy bonds and put the pressure on yields. Buying bonds means extra demand, the price goes up, the yield comes down. That's in general what would happen, and that would drive mortgage rates a little bit down. I hope this was easy to understand for
It
an
really
average fifth
was.
grader.
Big Mike, I am very impressed with how you described all that, because I was following along the whole time. I didn't glaze over, I promise. So looking in your crystal ball for the listeners out there who are flipping houses, does this mean we are going to have more buyers coming to buy our flipped properties?
So it depends. It depends on the market. This is a complicated question, because what we see is all real estate is local, and there are plenty of markets where the prices already fell quite a bit in residential,
Yes.
while some other markets are holding up really well.
Mm-hmm.
So I don't know, depending on where you are. It's a function of local, but in general, when you lower interest rates, you create more affordability.
Okay.
So you're going to have more retail buyers being able to afford these houses because the mortgage rates are down. On the other side, low interest rates may actually start new construction starts. So in general, as rates come down, it creates more supply, and it also increases more demand. For now, higher interest rates have been demand destruction. People just can't afford them. So I don't know exactly. This will depend on the market. In general, affordability increases. So for the markets where affordability makes a big difference, the prices are high, it could help more than where the price is low. And yes, you got a little bit better interest rates, but it doesn't really make that much of a difference.
Gotcha.
From the mortgage payment perspective.
Thank you for that, because I just listed a property today which was one of our new builds. So I'm like, TikTok, where are all my showings? I'm waiting for my phone to start buzzing here. So, all right, well, goodness. I mean, we've already spoken for 25 minutes, and that, like, that was my very first question. So the Chat GPT spit out some of these great questions here. And here is one. In this capital constrained environment, we're hearing a lot more about mezzanine financing. So first of all, what the heck is mezzanine financing, and why do you think it's gaining momentum right now?
Sure. So this mezzanine financing, it's usually not primary debt, but secondary debt.
Okay.
And the best way to describe it is, this is what I mentioned a little bit earlier. When the deals run into problems, and originally most of these deals capitalized, there's a purchase of the property, and there's a primary mortgage, and there's equity. So what happens is, what if you need fresh money on the deal? People try capital calls. They reach out to investors, again, on commercial deals. They reach out to investors and say, we need more money. And they issue capital call to all the owners. And 70% of the owners says, I don't have the money, or I don't want to give you the money. I'm just using an example. It could be 95%. They just can't raise the money any other way. So what happens is the owner still needs to raise capital, otherwise they can't pay the bank. So they go to capital providers, including us. We play in that space too. And they say, well, we got a great project, but running out of money, where we need the capital to finish construction. We need the capital to pay the bank. But here is the reason why we believe the project is still worth more money, significantly more than our current mortgage. Right? We look at the deal and say, yeah, looks like you bought it right, you renovated, you increased rents, you have a great property. We're open to give you mezzanine financing. It just simply means we will give you fresh capital, but it'll be between the bank loan and the old equity raised.
Okay.
And it is mezzanine, either mezzanine equity or mezzanine debt. It comes in, it's going to have heavy terms, and it's going to have control provisions and heavy interest rates and possibly profit share. But then it comes in sort of as a rescue and recovery capital, because without it, you just can't stay afloat. So you either consider it as a way to survive and then hopefully thrive, or you run out of money and then you have unpleasant conversation with the bank and you go into receivership and see what happens from there. So this is a result of the current market conditions, and you can make a good return on your investment by participating in that instead of trying to buy new. If you can't get a great deal to buy new, well, maybe somebody is willing to get fresh capital, and you can, in some cases, we've even seen new money takes over the project, and the old money literally says, okay, you live in the project, but you're in the back of us, and you even lost your control provisions. So
Got it.
that's kind of the high level what is mezzanine financing.
Interesting. And as someone who under budgeted for a project recently because some things just skyrocketed, which threw us for a loop, like our electrician almost doubled in price, just crazy things. So, and I can also think back during COVID, for example, this house that I'm in, we renovated this house and it took us 5 minutes. So there's time in there that also delayed the project because it took us 5 months just to get the windows for us to pass our framing inspection. So just because of supply and demand for things coming in. So I never even heard of mezzanine, what is it called? Mezzanine financing. So
Could be mezzanine debt or mezzanine equity or preferred equity.
okay.
It's something to think of it as in between the mortgage and the previously raised equity capital.
Gotcha. All right. Well, thank you for that. So
And just one
yeah.
quick comment. It's funny how you said it. This is the absolute truth. Wide majority of the projects, when things were going well, they were not prepared with significant reserves for exactly what you mentioned, for
Yep.
longer time, for high expenses, and other unknowns. And the reason they did this is because they needed to sell the project. And when they sold the project, they wanted to have rosy numbers or rosy projections. And if you had to create massive reserves, would the project have made the same economic sense?
Hmm.
And the answer is no, probably not. It depends, right? But what's really interesting, they all assume, well, later I can raise money later. I can raise money later. Well, until you can't, because the market tightened up and raising new capital became very, very difficult. But this whole situation now is drastically different. Most of the projects today, they overcapitalize with more reserves. And it's totally almost the opposite of what it was before because people have learned from the experience.
Interesting. Well said. All right. Which direction are we going to go here? So, passive income is a huge focus for a lot of my audience listeners. How can investors build a predictable passive income during these times of economic volatility?
Sure, it's another great question. And I'll tell you this, there's real estate and there's real estate and there's real estate. There's different parts of real estate. And most people just say, okay, commercial deals. Well, what is commercial deal? There's so many different ones. So, and there's residential, and there's so many different ones. The reason I'm saying is certain type of deals have high predictability in nature. So let me give you some example. If you're a lender, you loan money, you're a hard money lender. It's just a simple example, and you have a very low risk loan. Your cash flow is very predictable. You're okay if the borrower defaults, they fail in a project, you will foreclose, then you will sell the property. That is sort of a predictable setup. Now, you don't want to be in a defaulted condition and still foreclosing and dealing with a headache. It's just as an example. So, but I give you example of what is predictable, typically debt. Monthly payments every month, same amount, it's predictable. Now you go look at the equity side of the business. In equity, you have these wonderful multifamily projects. You have open air shopping. You have self-storage facility. You have industrial properties.
Parking
And they
garages.
yeah, there's park garages, there's all kinds of new strategies. But one of the most predictable, and most people don't quite grasp it, there's been a lot of popularity in multifamily. But let me dissect this. The shortest lease that you see is generally storage. It's a month by month lease, right?
Okay.
You go to multifamily, it's usually annual lease. Yeah, you can have 2 year, but say for the moment it's annual. What's longer term lease? Well, now you go into open air shopping and industrial. Why? Because tenants are commercial tenants and they are multi-year tenants. I'm purposely keeping office out of the whole conversation. Office got devastated by COVID, and office in my book most of the times is dog shit, pardon my French. But what I can tell you, what we see to be have done really well and continues to do well is open air shopping. People continue to still want to have experience. They want to go to these open air shopping plazas while enclosed malls have died or dying. And then on the other side, you got absolute triple net industrial.
I was going to say triple net leases. Yep.
We love it. So absolute triple net is highly predictable, especially you have a manufacturing client, especially if the company is bought by a private equity firm. They don't want to own real estate, but they want to own the business. So they'll sell real estate concurrent with their purchase of the business, and then they immediately lease back. And then we make sure that the company they bought is still in the same location, and they sign 25-year fresh lease with triple net structure and a lease escalation clauses. That strategy is one of the very predictable strategies. We've seen similar, a little bit less predictable, but close with some of these long-term leases. You got Starbucks, you got Cheesecake Factory, you got these very dominant multi-year tenants that continue to stay at the property, and they have strong corporate credit, and the chances are people still going to need, whether it's going to be recession or not. Maybe they'll substitute. They won't go get a very expensive cheesesteak. They'll very expensive steak, but they'll go to the Cheesecake Factory and get a steak for like $30, where you can, instead of paying $50 or $80 steak. So it's really interesting is these commercial properties can be a great predictable strategy, and returns there like clockwork. You start with cash flow today, and every year it's 2 to 3% net increase in the operating income, and the cash flow goes up every year, and the value is forced. Why? Because you start with NOI, let's use an example, $1 million. Next year it's $1,030,000. Next year it's $1,060,000 something. And then by the time you're done, your NOI went higher, and assume that the cap rates don't change. You could still sell it at the same cap rate that you bought it, but for a higher price. And if the interest rates come down, the cap rates will come down. You'll get a significant enhancement to your return by virtue of the interest rates changing. Does this make sense?
Yes, and thank you for that. And you had also mentioned a couple of conversations ago about someone buying the Sears and turning them into storage. Did you say that storage units? And then I interviewed a gentleman who would buy the old Kmarts and do the same thing and turn them into storage units. So there are,
Same idea. Yeah, it's
yes,
the same concept. It's the big box retailers.
yep,
At some point, Kmart and Sears were one. The one bought the other. I can't remember. I think, but
yeah,
they were big bucks. And yeah, I mean these concepts still exist, and it's so sort of strange. I'll just tell you this. Early in the summer, I was visiting Rochester, New York, where my family I have some family over there. And here I go to the Marketplace Mall, and these humongous big box components, instead of converting it to self-storage, they convert it to like racetrack for the RPM race cars. They're occupying the space of an old Kmart and Sears, and they're looking for alternative use or pickleball courts indoors or something like that. Otherwise, the mall is dead. And then you go shopping plaza 5 minutes away, open air shopping, and it's thriving. It's just people go there. So we've seen that consolidation of the few successful open air shoppings that have done well, and then the old big box retail has to be turned into something useful. And I gave you some examples of what
right.
I've seen.
All right. So you gave us some of these opportunities, but what are the biggest risks right now in commercial real estate? So I know you mentioned with the multifamily things and office, we don't need to get into office spaces, but what other areas do you think are a higher risk?
So I have a whole theory on the conversations. Years ago I developed investment quadrants. Like Robert Kiyosaki has his
Yes.
quadrants, Big Mike has his quadrants, right? And think of it this way: you have vertically income and growth, and then horizontally you have what I call them investment grade and speculative grade. So to me, speculative grades are the projects with a lot more risk, where you can
Okay.
actually lose money. So I still have very significant heartburn every time people talk about ground up. And I mean this with all due respect. People tell me, yeah, 2 years from now when we bring the product, I see exactly what you just described. Cost overruns,
Mm-hmm.
delays.
Yep.
And today the market is very, very nervous about these projects, and financing ground ups has gotten way, way harder because the risk is perceived to be significant. So you can still do really well, but you have speculative, your estimate, your guesstimate of what this property will sell for when you build. If you build it, they'll come, but what if they don't come?
All
What
right.
if you think you can sell it for this price, but you can't?
Mm-hmm.
So yes, everybody loves new product, but at the same time, you can't get a discount on a ground up today. This is the crazy part. People talk about ground up. I tell them it's wonderful, but can you get a discount on the plumber, on the electrician?
Nope.
Now it's harder and harder because immigration policy. A lot of Hispanic labor has been pushed out of the country,
Mm-hmm.
and there's a beauty and a curse to that, right? I mean, we
Right.
want made in America, but at the same time, we need more people who can do these projects, and we have fewer of them. So probably we're not going to see cheaper construction, right? And maybe you can get discount on the land, but land is only 8% of the cost.
Right.
So overall, future of these projects depend what you can sell for, and that is a little bit speculative in nature because you're sort of thinking, well, 2 years from now and I build 3 years from now where the price should be. And we don't know that. So that's the speculative type of projects. And in my book, they represent more risk, even more risk when the interest rates are high now.
Right.
And if the rates fall, things go smoothly, they can work out to be good projects. Here's the crazy part. We deal with this every day, and I see these projects don't pencil for great returns because the speculative risk, you either have to make crazy assumptions, or your return profile in these deals, because the cost of money today is high, is not that great. You go look at the existing property. When I can go buy something, and I'll give you the underwriting things we look at today. I can go buy an existing multifamily, for example. Um, we did a project early in the year where it used to be 125,000 a door. It's near Ann Arbor, Michigan. It's beautiful property. They rent about 1150 a month today, right? And it used to be worth about 125,000 a door in 22. Now we bought it for 79,000 a door, right?
Wow.
You get 35% off the price. That's an immediate, that's just one of the things you can look when you're looking at a deal. Am I getting a great deal relative to the price at the peak? And the reason we compare it to that, I want to get discount to the as is value, but I don't know what the as is value is. It's difficult.
Right.
There are not too many things transacting. So at minimum, you're looking at a pretty good discount to where the peak of the market was. Second thing, whenever we buy, we look at 2% spread between the income level, the capitalization rate. For those who don't know what's a cap rate is simply unlevered return on your equity. So if you buy something for $10 million and it gives you $600,000 income, you take 600,000, you divide by 10 million, and that's 6%. So that cap rate is simply unlevered without the mortgage. I don't care what the mortgage is. So the higher the cap rate, the higher unlevered return. And then you add leverage, you add a mortgage. So if you have a property, that property that I just mentioned, we bought at a 9% capitalization rate, meaning that we got unlevered 9% on our money, and we borrowed at 7. So when you have a positive spread between,
Nice.
we have 2% positive spread, every dollar of leverage increases cash flow, and you have a margin of safety. That's 2. And the third one is relative to the reconstruction cost. So it's $79,000 a door. What would it cost me to build a new property that looks like this, and let's call it 200,000? You're going to say, well, maybe it's not 200,000, maybe it's 180, but you're still getting a very steep, deep discount to the reconstruction cost, and that's a margin of safety. But you have to adjust for the condition and the age. So all I'm saying is that a property is old. Yeah, you're getting a great price, but you have to budget for all the work. So it's kind of best way to think about it. You add about a year for every year of age. You can add 1 to 2% discount for that aging process. But it depends how well it's been maintained. If it was recently renovated, it's very different versus it needs a lot of work.
Yep.
But these 3 elements is what makes you feel great about a deal versus. And you ask me about a risk. Well, why this is important? Because this is how you think about it. This is how you know you have a deal or you don't. Because if you're going to go into new construction, you're taking a lot of risk and uncertainty. And by the way, I'm not saying people shouldn't do it. They should just be aware that there is more risk related to that.
And thank you for clarifying that as well, because some people are probably sitting there like, oh, I don't even want to go into real estate right now. But you have been through, before we go to the second part of the podcast here, last question here. So you've been through a few cycles because you started back in 2009. What is your experience and your analytical approach? Where do you believe we are in the current cycle, and what do you think is coming next? I mean, you kind of touched on a few points, but just kind of wrap it up in this first part of the podcast here.
Sure. So we've seen, at least in the commercial real estate, a fast reset. As Fed hiked rates, we've seen significant revaluation of all these properties. Multifamily, for example, reset between 20 and 40% price discount, depending where the market. Many other asset classes reset, but less. And it depends where. There's some markets are more cyclical, and in Midwest, there's a lot more steady eddies. So it really depends on where.
Yep.
But in general, what we talked about in triple net industrial is really fascinating how that works. That works on a spread between the cap rate and the interest rates. And that spread in that asset class is about 150 to 200 basis points, 1.5 to 2%. So as interest rates are about to start going down, you're going to see cap rates coming down and values coming up. So you can actually mathematically see that we are likely have entered our recovery phase.
Good.
And do we know, are we in early recovery or recovery is yet to come? We don't know, but it's very hard to time the market. What we do know is bonus depreciation is back. Thank you, President Trump. From that perspective, that's a huge tailwind for the entire commercial real estate industry and residential industry too. So you're going to get more people getting bigger tax benefits. They're going to be more motivated to buy. 2, lower level of interest rates. So both of them are such significant tailwinds that we expect the recovery has started. So it's where we are now. So you have a huge expansion all the way from the depth of great financial crisis, 2008-9, all the way till, the COVID was a blimp, right? You had a quick sort of up and down, and then it continued to march up. But if you eliminate the COVID impact, we basically seen gigantic expansion, fast and furious reset from 22 till, let's call it 24. And now we are on the way to recovery in 25 and into 26. So that's where we are from a cyclical perspective. It's really hard to find better timing than to enter the market now on the commercial front. On residential, I would caution it depends where. So some markets, we may still see affordability being a big factor. I know Midwest, a lot of other markets, affordability is super healthy. You go some parts of California, this price softening because affordability is so difficult. And I don't know how exactly you improve affordability other than lower rates. Then you still have some issues related to local dynamics. So just pay attention to the local market and residential.
How's that affordability up there in Brooklyn?
Affordability, you know how crazy it is? I don't know how it is today, but a few years ago, I had this statistic talking about affordability in Brooklyn. I would ask people a question. What is the most expensive place in the United States of an average house price relative to an average income? Right? Affordable. Basically, what county has the worst affordability in the whole freaking United States? And it was Kings County, Brooklyn. This is the crazy part because the prices are very high.
Right.
And a lot of people, they work. They are school teachers, they're firemen. They don't make crazy income. So this is the crazy part is that people pay a lot of their income for housing. So Brooklyn is not necessarily a very affordable place. The difference between Brooklyn and Manhattan prices are even higher, way higher, right? But at least people who live in Manhattan, they generally make meaningfully higher wages.
Well said. Well, Big Mike, this has been such a great conversation. I should call you Professor Mike because you do such a great job of explaining things, and I appreciate it. My husband does not explain things. He's like, don't you just understand it? I'm like, no, you can't understand it for me. So I am very, very impressed with your tactics of how you explain all that. So thank you. We are going to move to the second part of the podcast here, which is what makes you a badass. And I use the acronym BADASS, and the first letter is B for book. What's a book that's made a huge difference in your life?
Lots of books. I mean, I hope I'll try to give you one. So the one I really like recently called Sometimes You Win and Sometimes You Learn.
Oh, okay.
Yes. And the funny thing in the book, it says sometimes you win, sometimes you lose. Lose is crossed. And it says learn. It's John C. Maxwell is one of the most prominent authors.
Yep.
So he wrote that book. It's a great book. It's really all about learning from your experience. And this is the most important thing to have learner's mindset. Even if your project doesn't go the way you expect, just learn. Learn. Life is about learning. So that book is very encouraging. It just, in my view, helps many other sources. But I can give you a ton of other books, but I'll just stick to one at least.
Well, it's been a hot minute since I've read one of his books, so I'm definitely gonna have to check that out because I was just reflecting recently how shitty the last 2 years have been in real estate, well, for our business particular. So I am trying to take everything as a learning experience. So that sounds like I need to put that book on deck. So thank you for that. All right, the first A in badass is for advice. You've given us amazing advice today, but what's the best piece of advice you've ever received?
Yeah, it's hard to say over the years. Yeah, I wish it was a one simple thing. And I would say, here is a funny thing. There's certain things you can, I'm a mathematician and you try to quantify things and you can't. I'm also a chess player and all strategy and all precision, and sometimes you can't. So in investing, risk, understanding of risk. And what is risk? Risk fundamentally is a possibility of a loss.
Okay.
Most people don't even look at risk. So I've learned from Howard Marks, who is one of the greatest business. I mean, he's a founder of Oak Tree, one of the most successful hedge funds. And he talks about risk, that sometimes you don't understand risk before you invest, and sometimes you don't even understand after. So this is the crazy part. You can invest into something that was really theoretically great investment, and it failed. You made the right investment decision, but it still failed. And you may not understand the risk before or after. But what's really important is to be a good scholar and improve your skills where you can intuitively perceive risk and see the hidden risks. Sometimes they're not visible, and hidden risks exist everywhere. Sometimes you don't see a risk until an earthquake of certain magnitude hits. The house is just wonderful. It was built great. Everything is fine until something to the degree happens. So the advice is really be a scholar of every time you invest, try to understand the risk of all things. And after the last couple of years of the market reset, kind of what I've really learned and changed my mindset is my rule number one, whenever I try to invest, is invest in what you think is not going to lose money under any circumstances. So downside protection, risk mitigation, and be prepared for the unprepared.
Excellent. Thank you for sharing all that. All right. The D in badass is for drive. What drives you to be successful?
Family. I mean, as I said, I have
Four
a
monkeys.
wonderful wife. Yeah, 4 monkeys and a cat. That's the cat, a real cat. I mean, my kids are good kids, but just kind of family drive. Some people, I mean, I'll crack another joke because people need entertainment. All these podcasts are wonderful. By the way, yours has been very engaging, but
Thank you.
years ago, before I went into real estate, I was in high tech world. I was 15-year technology from rank and file all the way to technology executive. We had this crack this joke. So and this is kind of reveals the nature of, unfortunately, a lot of our lives. So what is how we supposed to live, right? God's supposed to be first, then the family, and then the work, right? That
Right.
this is what it's supposed to be. But the joke was, in these technology engineers, we pray to God that the family understands that the work comes first.
That is
So
hilarious.
get your priorities right. The bottom line is, whatever happens, get your priorities right, and sort of, you got to have always God in your heart, right? And serve your family first, and if you can do other great charitable work and help others, that's wonderful too.
Absolutely. Wow, you are such a great person. I appreciate all that. All right.
You're too
These
kind.
well, I appreciate it. So the second A in badass is for aspiration. I'm a big goal setter. So what is a goal you are currently working on?
I just want to go to the moon. That's all it is.
Are you
No,
serious?
I'm kidding. I'm
Oh,
kidding. I mean, yeah, it might become an opportunity soon enough, but
yeah.
no, I just want to make a difference in some people's lives. It's like, obviously your own family, your own kids, but you work with people. I just want to, every time I interact with people, I want to make sure that everybody takes it with a smile and positivity, and take every negative things that happen to you in life. Like, life is just full of it, full of shit sometimes. Sometimes things
Absolutely.
outside of your control. Sometimes it's your own mistake, sometimes somebody else's mistake. Sometimes people cut you off and force you to go in a car accident. It has happened to my wife here in Brooklyn.
Mm,
Some crazy person goes around, cuts you off to avoid the accident, slams the brakes, and you hit a parked car, right? How fair is that? And could be worse, right? You could have killed somebody because of some
right.
idiot or crazy person. But you still have to maintain positivity no matter what happens in life. Just be a good, positive person, and impact other people's. That's my achievement. It's not, I'm not shooting for stars, not going to the moon. Just live every day in a positive manner.
Well, that is just lovely, and it is very evident in how you speak. So thank you. All right, the first S in badass is for systems. I'm assuming a mathematician has some really good systems in place. So what systems do you use to help you achieve success?
So, well, this is a long question. So, we started to adopt AI. I'm not even going to go there, but there's all kinds of opportunities to use technology in your business. So we use, obviously, CRM system to track our investors and potential leads. We use third-party administrators. We use very competent CPAs. By the way, you started, and this is all about a team sport, right? So to have a successful organization, you got to have all those elements. You got to have good attorneys, good CPAs, good accounting people. You need to have good experts in whatever strategy you do. So building a very, very good people team is very important. It's part of the systems. Having a team is part of the
Huge.
system.
Yeah.
Yeah, and then obviously using number of technology platforms that work really, really well. And I'm not going to spend a ton of time on every element, but I'll just give you one really cool idea. Just hit me recently. I really, really enjoyed it. And the last CG presentation, how about that? The collective genius. One of my good old friends, he had a virtual board of advisors, and the
Oh,
virtual board of a digital board of advisors. So what he did is he taught his chat GPT with a smart prompting to create board of advisors. And he had number one, Jesus Christ. The number two was Warren Buffett. The number three was uh, Richard Branson, and etc. A number of some of these great minds, including Marcus Aurelius, and another historic characters throughout, from ancient times all the way to current days. What's really interesting is a lot of texts and things that they've written. The Bible, right, has how would it be, based on the Bible, right? So you have each
right.
each person speaks from their works, and ChatGPT can actually study every word of the Bible, every word of what Warren Buffett written, every word of Charlie Munger, and everything that has been written, and you can pose a question and it can give you a good answer. So some of these things, talking about systems, it's an evolving process. This could be a great system where you can get a board of advisors. You don't know how to do it, but you train ChatGPT to create a little board that works for you, and you can put people on or off that you like, and you can get good advice.
Well, I have an AI bot named Penn, Penn, who writes all of our questions for us and puts the bios and everything together. So he is one of my chat GPT bots. So yes, there is a huge area for that. So before we go to the final S in badass here, I mean, what do you have to offer the audience? I know you have a podcast, you have a book, you have Tempo Funding. I did not even get into this. Big Mike Fund is your podcast. How can you serve the audience, and what type of things do you provide besides your badassery on just your podcast alone?
Yeah, I have nothing to sell. I don't
I
have
didn't even ask you before we started.
yeah, I mean, I will start this way, right? Now we're gonna get really easy and cheesy, right? So the podcast, and I start, if you're bored, you got nothing else to listen to. Obviously, your podcast is so wonderful, people never gonna be bored.
Well,
But
thank
if
you.
somehow they want to listen to something beyond that, you can go to bigmikefund.com, and you can tune into Big Mike Fund podcast. And if you misspell it, you forget the D at the end, you go to bigmikefund.com. I promise it's not a kinky site.
I love it. Well, the final S in badass is for success. What does success mean to Mike Zlotnik, aka Big Mike?
It's kind of like this, right? The wisdom. When I was a kid, you watch your parents, and I grew up with heavy influence from my mom, and all my life, she kind of spent a lot of time helping me be a better person. And over the years, as I got older and older, I'm not that old, but as I get older, I kind of live my life more through my own kids, and I see what they do and their success. So, success to me is ultimately having my kids be happy. It's almost to the point where the best way to think about this, and people ask, what business is McDonald's is in? Although, everybody knows the answer to that. It's real estate. And then you ask, what business Disney is in? Most people don't know that. Disney, 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 Mickey Mouse. But what business Disney is in? In the business of making great memories.
Ah,
So the whole thought process here is, my success is, is great memory with kids, making sure they're happy, healthy, they become good, productive folks. That's it. That's like, this is how I view success. I don't view success any other way. As I get older and older, it's literally, money doesn't matter. Your health continues to get a little worse, little worse, little worse. So you just want to see, your kids be happy, successful, and if it's not your kids, it's other kids.
well, you have,
Better world. How about that?
yes, very good. Well, you have four lucky monkeys in your house, and I bet they are very grateful to have you in their lives. So, Big Mike, thank you so very much. How do people find you if maybe they have questions? They can just go to the podcast. Is there another website where you, or anything?
Yes, you can navigate from this website, bigmikefund.com. There's a link to the corporate site. There's a podcast, so people can literally go from there. I do have a busy life, so if people reach out, I'll try to be, as responsive as I can. But we have a team. If people can go to the corporate site, they can sign up for our newsletter. You'll get some good educational
Nice.
content. And yeah, I mean, we are in the business of basically marrying money and opportunity. So folks who have, capital, they reach out and they want to see what deals we have. And then some people reach out, hey, I got a great deal. What do you think? And if the deal sort of fits, we will first underwrite who you are, how did you find out. We always jockey ahead of the horse. So we do look at deals and we do look at
Nice.
capital. So we always need both. That's kind of
Yep.
the business we're in.
So bigmikefund.com, and they can sign up for your newsletter. That's a great start, at least for the listeners. Okay, perfect. Big Mike, this was such a pleasure having you on the show. You are excellent at your explanation of things, and you have given me hope in this real estate market because it's been a rough 2 years for us, but I'm seeing the light at the end of the tunnel. So thank you so very much for coming on the show today and sharing your badassery.
Thank you, Jen. You are wonderful.
You
host,
are
and
wonderful.
I'm grateful.
All right. Well, that is all. Thank you for listening. We'll catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josey by visiting therealjenjosey.com or become a member of RAIN by registering on rainmastermind.com.